There is a tax nightmare that hits thousands of freelancers, side hustlers, and creative entrepreneurs every year. The IRS audits your business and decides it is not actually a business. It's a hobby. When that happens, the tax consequences are devastating. You still owe income tax on every dollar of income, but you lose every single deduction you claimed. And you owe back taxes, interest, and penalties on top of that. This is not a rare situation. The IRS has a specific set of rules for this, a 9-factor test, and they use it aggressively against photographers, writers, artists, musicians, coaches, consultants, and anyone else with an activity that could be seen as having a personal enjoyment component. Here is everything you need to know about the hobby versus business distinction and how to protect yourself. First, let's understand why this matters so much. Before the Tax Cuts and Jobs Act of 2017, hobby expenses were at least partially deductible as miscellaneous itemized deductions. That's gone. Under current law, which applies through 2026 and beyond, hobby expenses are not deductible at all. Hobby income, however, is fully taxable. That is an incredibly bad combination. You report 100% of the income. You deduct 0 of the expenses. You can owe tax on money you did not actually keep after covering your costs. A freelance photographer who earns $30,000 shooting weddings but spends $25,000 on equipment, editing software, and travel, and is classified as a hobby, still pays income tax on the full $30,000. That $25,000 in expenses is completely worthless to them at tax time. At a 22% tax rate, that means paying $5,500 more in tax than if they had business status. The IRS 9-factor test comes from Treasury Regulation 1.1832b. No single factor is decisive. The IRS looks at the whole picture. Let me walk through all 9. Factor 1. Does the taxpayer carry on the activity in a business-like manner? This means keeping complete and accurate books, separate business bank accounts, a business plan, professional records, and operating like a real business rather than a hobby. Factor 2. Does the taxpayer devote significant time and effort to the activity? Someone who works on the activity 40 hours a week signals a business. Someone who dabbles on weekends signals a hobby. Factor 3. Does the taxpayer depend on income from the activity for their livelihood? If this is your primary or a substantial source of income, that supports business status. If you have a day job and this is extra fun money, that cuts the other way. Factor 4. Are the losses due to circumstances beyond the taxpayer's control, or are they typical startup losses? Early losses in a new business are normal and understandable. Losses every year for 10 years in a row look more like a hobby subsidized by tax deductions. Factor 5. Has the taxpayer changed methods of operation to improve profitability? This is about showing you are actively trying to make money. Experimenting with pricing, seeking new clients, adjusting services, these show business intent. Doing the exact same thing year after year with no attempt to fix losses does not. Factor 6. Does the taxpayer or their advisors have the knowledge and expertise needed to carry on the activity as a successful business? Being an expert in your field, or hiring one, supports business status. Factor 7. Has the taxpayer been successful in making a profit in similar activities in the past? A track record of turning ventures into profitable businesses supports the claim that this one will be too. Factor 8. Does the activity make a profit in some years, and if so, how much? Occasional profits matter, even if there are also lost years. Large profits in some years help your case. Factor 9. Can the taxpayer expect to make a future profit from the appreciation of assets used in the activity? Some businesses build long-term value even when generating current losses. Think a cattle ranch increasing in land value. Now, the profit presumption. If your activity is profitable in at least 3 of the last 5 consecutive tax years, the IRS presumes it is a business, and the burden shifts to them to prove otherwise. For horse breeding and racing specifically, the rule is 2 profitable years out of 7. This presumption is powerful. Focus on achieving it when you can. But be careful not to interpret this the wrong way. Failing the presumption, being unprofitable for 3 or more years out of 5, does not automatically mean the IRS classifies you as a hobby. It just means the burden is on you to prove business intent using the 9 factors. You can still win the argument with strong documentation. Here is what happens if the IRS reclassifies you as a hobby after an audit. They go back and eliminate all your deductions for the years under review, typically 3 years, sometimes more. You owe back taxes on the income with no deductions. You pay interest from the date those taxes were originally due. And you may face an accuracy-related penalty of 20%. On $20,000 in disallowed deductions per year over 3 years, at a 22% tax rate, that is $4,400 per year in extra taxes, plus interest, plus the 20% penalty. The total hit can exceed $20,000 easily. Here is how to protect yourself. Open a separate business bank account. Do not commingle personal and business funds. This is the single most visible signal of business-like behavior. Keep detailed records. Invoices, contracts, receipts, client communications. Document everything. Write a business plan, even a simple one. Update it. Show that you are treating this as a money-making venture. Track your hours spent on business activities. Market your services actively. Have a website, business cards, or professional profiles. Show you are seeking clients and revenue. Reinvest profits or adjust strategies when you are not profitable. Show the IRS you are trying to make money, not just having fun. And if you are in a loss year, be prepared to explain why. Startup costs, equipment investments, economic circumstances, all of these are legitimate explanations the IRS will consider. The hobby versus business distinction is not just a technicality. It is one of the highest stakes tax issues you can face as a freelancer. If you are doing work you love that also happens to generate some income, protect it. Make it a real business in every practical sense of the word. Subscribe for more IRS rules that directly affect freelancers and self-employed professionals. See you in the next one.